Welcome back to the Commodities Institute podcast. I'm Emily Costa, and today is Thursday, April 2nd, 2026. Let's begin with oil, because at the center of this storm sits one of the most important choke points in the world, the Strait of Hormuz. What we're seeing right now is not just a disruption of supply, but a disruption of how oil itself is priced. The Dubai benchmark, which underpins pricing for roughly 18 million barrels per day of crude, is facing what some traders are calling a structural breakdown. This benchmark typically relies on crude streams loaded within the Gulf, particularly from the United Arab Emirates, Oman and Qatar. But with shipping through the strait effectively halted due to security risks, the very oil that defines the benchmark cannot reliably move. Think about that for a moment. A pricing system designed around physical delivery is now trying to price cargoes that may not even be loadable. Prices have surged dramatically. Middle Eastern crude has approached $170 per barrel, surpassing even the peak seen during the 2008 financial crisis. And yet, despite these high prices, liquidity is drying up. Some traders have stepped away entirely from Dubai-linked contracts, while others are scrambling to shift toward Brent-linked pricing mechanisms. What makes this even more complex is how quickly the pricing agency adjusted the benchmark. Within days of the conflict escalating, the number of eligible crude grades was reduced, cutting deliverable supply by roughly 40%. That kind of rapid change is almost unheard of in a market that typically relies on long consultation periods. And then there's the trading activity itself. One major player accumulated an enormous position in Dubai-linked partials during March, contributing to upward pressure on prices. Some analysts are calling it one of the largest oil market positions ever seen. Whether or not that proves true, it underscores just how concentrated and fragile this market has become. Now, beyond pricing mechanics, the physical reality is even more concerning. According to the International Energy Agency, more than 12 million barrels per day of oil supply have already been lost, and disruptions are expected to worsen in April. This is not just about oil, it's also about liquefied natural gas, diesel and jet fuel, and the consequences are beginning to spread geographically. Asia has already felt the strain, particularly in refined products like diesel. Europe, however, may be next. As existing shipments contracted for the conflict begin to run out, the supply shock will translate into higher inflation and slower economic growth. In fact, the IEA is now warning that this could become the largest energy disruption in modern history, surpassing even the oil crises of the 1970s. Now let's shift to natural gas, because this is where we're seeing a fascinating divergence in global behavior. The United States has stepped in as a critical supplier, with liquefied natural gas exports hitting a record high in March, 11.7 million metric tons. Facilities are running above capacity, and new production units are coming online just as global demand surges. Asia, in particular, has been pulling in more US cargoes, with shipments more than doubling month over month. But here's where it gets interesting. China is doing the opposite. Rather than competing for supply, China is reselling liquefied natural gas cargoes into the global market. Why? Because domestic demand has softened and alternative supplies like pipeline gas and local production are sufficient for now. So while countries like Japan and South Korea are scrambling to secure energy, China is effectively arbitraging the market, capitalizing on high spot prices by exporting excess cargoes. It's a reminder that in commodities, positioning is everything. The same disruption that creates scarcity in one region can create opportunity in another. Now, let's move into metals, where the story is less about immediate disruption and more about structural imbalance. Take copper, for example. Chinese smelters had previously agreed to cut output in response to falling processing fees and oversupply. But recent guidance suggests those cuts are not materializing. Production is either holding steady or even increasing. Why does this matter? Because the economics of copper processing have flipped. Instead of being paid to process raw materials, smelters are now paying miners due to tight concentrate supply. That's an unsustainable model, and yet production continues, largely supported by byproducts like sulfuric acid. This tells us something important about the broader metals market. Even when margins collapse, production doesn't necessarily follow, especially in systems where scale and byproduct revenues can offset losses. Aluminium, on the other hand, is seeing a very different dynamic. Supply disruptions in the Middle East, combined with damage to key smelting facilities, are tightening global availability, and China is stepping in to fill the gap. Export forecasts for Chinese aluminium products have been revised sharply higher, with some to what are now pointing to double-digit growth. Prices on international exchanges have risen significantly more than domestic prices in China, creating strong incentives for exports. So again, we see divergence. Copper struggling with oversupply and distorted economics, while aluminium benefits from geopolitical disruption. Now let's turn to agriculture, where the impact of energy prices is being felt in a more direct and human way. In South Africa, farmers are facing a dual challenge: rising diesel costs and uncertainty around supply. Fuel prices have surged dramatically, and in some cases, farmers are unsure whether they'll even be able to secure enough diesel to complete their harvest. This is not just a cost issue, it's a logistics issue, a planning issue, and ultimately a food security issue. And it's not isolated. In Egypt, the government is moving to increase domestic wheat procurement prices in an effort to build strategic reserves. The goal is clear: reduce reliance on imports and insulate the country from global volatility. These are defensive moves, and they highlight a broader trend we're seeing across agriculture. Countries are prioritizing self-sufficiency and stockpiling in response to geopolitical risk. Finally, let's touch on dry freight and global trade flows, because this is where the cumulative impact of all these disruptions becomes visible. Shipping routes through the Middle East have been severely affected, forcing vessels to reroute around Africa. This adds time, cost, and complexity to global trade. In Kenya, for example, millions of kilograms of tea are sitting in warehouses, unable to reach key export markets. Losses are mounting weekly, and the longer the disruption continues, the more pressure builds on both producers and exporters. This is the hidden layer of commodity markets. It's not just about supply and demand, it's about movement. And when movement breaks down, the entire system feels it. So where does all of this leave us? We're looking at a commodities landscape defined by fragmentation, pricing systems under stress, supply chains rerouting, regional imbalances widening, and governments stepping in to stabilize domestic markets. This is not a temporary spike or a short-lived disruption. It's a structural shift, and one that will likely reshape trade flows and pricing mechanisms for months, if not years to come. And as always in commodities, the question isn't just what is happening, but who is positioned to navigate it. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.